Friends, welcome again. In the previous session, we are learning about various sources of long-term finance. And this time in this class, we'll be learning how to compute the cost of these sources. As you know, these sources includes debt, equity, preference shares, reserves, okay, hybrid securities, okay, all these things are included. So how to compute their cost. And finally, we'll be also learning how to compute the weighted average cost of capital. So let us initiate the class. Going to share my screen with you right now. So you see, again, look at the syllabus. This portion we have completed. Now we are going to learn this computation of cost of equity, cost of debt, etc. These are the things we have already learned. Now at this stage, once again, let us recapitulate that what is the functions of business finance. So you see, if finance manager or CFO takes investment decision, it also takes financing decision. Now, in this chapter, when we are learning the cost of various sources of capital, we'll be dealing with these financing decisions. So, what is important here now is the cost of capital. That is important. We need to know how to compute the cost of capital. Capital structure, that means the combination of capital, how much debt, how much equity, what is the right proportion, or right ratio of doing all these things. That is important for us. In this context, we'll be also learning cost of debt and cost of equity. Cost of capital includes these two things. Okay, all these things we'll be learning. We're going to learn. And this slide again explains how capital structure decisions are important for capital budgeting decisions. Capital budgeting decisions means investment decisions. So business houses, they need money for replacement of their asset, for modernization of their asset, for expansion, for diversification. These are the purposes you see for which money is needed. And this money has to be raised through finance. Now, you have to think about the source of money. This is the requirement, and these are the possible sources. Internal funds, that means reserves. If money is available, that is a source. Debt is another source. External equity, that is issuing new equity. This is one more source. So this is the requirement, and these are the possible sources. And if you want to decide that money has to be raised, you have to take decision regarding capital structure. You have to look at what is your existing capital structure. That means how much of debt and how much of equity we are already having. And what is the desired debt equity mix? What should be the debt? What should be the equity? That also you have to decide. Then one more thing is important or relevant in this situation is what is the payout policy? That means how much money is available for distribution to shareholders. Okay. And what is the policy? Whether company would like to pay that money or like to retain that. On that basis, the desired debt equity mix decision or capital structure decision is taken. And once you've decided that this will be our debt equity mix, suppose we'll say that I need 1 lakh rupees and 60,000 will be my own fund and 40,000 will be debt. So this is my capital structure decision. That means I'm deciding a mixture of debt and equity. And once I've decided this, the debt equity ratio is, let us say, 40:60. Then it has effect on my return. If I'm taking 40,000 debt, then I have to pay interest on it. So that interest will be affecting my profit. That is my return. And it has effect on my risk. Let us say 40,000 debt I have taken at the rate of 10%. That means each year I have to pay 4,000. If my profit is not 4,000, how can I pay? So this is the risk. If you take more debt, I'm taking or I'm assuming more risk. Right? So the effect on return and effect on risk also needs to be considered when you're taking this capital structure decision. And this risk and return will be affecting the cost of capital. What is that cost of capital we are going to launch? very shortly. And the cost of capital in turn affects the value of the farm. Value of the farm can be maximum if overall cost of capital is minimum. That's the inverse relationship. Everyone wants to maximize the value of the farm. Okay. And at a particular capital structure, when value is the maximum, you can refer to that capital structure as optimal capital structure. That is the optimum capital structure. So everyone desires that this should be my capital structure. I think you got a fair idea of what is this, how this capital structure is relevant. Okay, what is long-term finance? You are already aware of, and what is the purpose of long-term finance? Normally, to acquire the fixed assets or to acquire the permanent part of the working capital, we need long-term finance. Permanent part of the working capital means to run the day-to-day business, I need some working capital. But some working capital is permanently needed. Every day I need that. So it is a long-term requirement, you can say. So to run my business monthly, I need 1 lakh rupees. But sometimes in peak season, I need 3 lakh rupees. Sometimes I can manage it 50,000 rupees. But always at least 50,000 rupees should be there to run the business. So throughout the year, I need 50,000 rupees minimum. But sometimes it may be 80,000, sometimes it will be 1 lakh. So the 50,000, you can say that the permanent part of the working capital. That can be financed through long-term sources. And many times for growth and expansion of the business, long-term finance is also needed. Okay. Depending upon the nature of the business, nature of the goods produced, nature of technology, our finance requirement will vary and capital structure may vary. Okay. And if you try to analyze what is this cost of capital, please understand that if when the business needs someone or business acquires equity or take a loan, it has to pay some. That is the cost. And to pay that much, business needs to earn. So minimum he should earn what is required to be paid. Okay. That means the rate of return which a company has to earn in order to meet the earning requirement of the investor. So the earning requirement of investor is the cost of capital. Minimum you have to earn the earning requirement of the investor. That is the minimum. And if that is earned, then the market value of the shares can be maintained. Otherwise, the market value of the shares may go down. If you're earning more than that, then the value of the shares will go off. That's simple principle. Okay. And there is a concept of opportunity cost of an investment. What is that? Opportunity cost. Rate of return which the company would otherwise be able to earn at the same risk level as the investment has been selected. Let us say you got some money. Okay. And if you want to do a business, if you're going to do that business, let us assume it is expected that you can earn around 20%. Okay, so business expected return is 20%, right? But if you do not do that, do not start that business, you may keep that money in fixed deposit, you can get 6%. This means you got an opportunity to earn at least 6% without doing that business. And if you do that business, you're going to lose this 6%. So this 6% is your opportunity cost. Okay. Right. So you are losing that. That will also, for the business, that is also cost of capital, because as a promoter, as an investor, you could have earned that money, you are losing. Okay. This is the rate of return. You can say 6% is the rate of return, which otherwise you'll be able to earn. That is, so to understand cost of capital, you also need to understand the concept of opportunity cost. And this cost of capital is used, let us say we know cost of capital is 10%. The 10% is used as a discount rate for determining the present value of the estimated cash flows. Try to understand. Every business generates some cash flow. That means in future, you'll be getting some cash. Let us say in first year, you may get 1 lakh, second year, you may get 1,20,000, third year, you may get 1,40,000. But these are the cash flows are realized over a period of time at different amounts at different years. They're earned in future. Okay, but investment you are making right now. Suppose you are going to get 1,50,000 at the end of 3 years. The present value of that 1,50,000 is less than that. That is the concept. After 3 years, you are getting 1,50,000. But what is that 1,50,000 today's value? That's the present value. Maybe 1,10,000. So 1,50,000 at the end of 3 years. But today the same value is at 1,10,000. The same thing is valued at 1,10,000. That means to bring that 1,50,000 to 1,10,000, I have to give a discount. At what rate I should discount? It's a future I am going to get some. What is the present value today? I need to discount now. But what is the rate for that discount? At what rate I will be discounting? If I know my cost of capital, then I'll be discounting at that rate. Right? So cost of capital is used for determining the discounting rate also. That is the importance of cost of capital. Okay. So you can read this slide now. It's the required rate of return necessary for capital budgeting projects. Means for investment decisions, it is important to know the cost of capital. It determines how a company can raise money. If you know the cost, then you can decide that what is the cheapest source, and you should like to get money through that source. Okay. And firm should receive at least that much of money. Okay. So this is the importance of cost of capital. Here, one more concept you need to know. Since we have learned there are different sources, maybe equity, maybe debt, these are the different sources. Okay, each source has got a cost. They are called as specific cost. For example, cost of debt, cost of equity. And there is an overall cost, which is called as weighted average cost of capital. That means considering all the sources, we have to find out what is the overall cost of capital. So both are important. Each one is important because on that basis will decide what is the cost of each component. And on that basis, you will decide the overall structure. And once you've decided this is the structure, that is, this is the proportion of debt and equity, we will be knowing what is the overall cost and combined cost. And once we know this is the cost of my overall cost of fund, it will be easier for me to take investment decisions. How much I should invest, I should. Okay. Friends, we'll stop here today. Next class, we'll be learning some of the assumptions regarding to cost of capital. Then we'll see how to compute that cost of capital. For you, friends, at your level, it becomes very little technical, of course. So don't worry, we'll be there to help you. Thank you very much. Thanks a lot.